So if you have your books, 23.7 is what we want to start with. And I'll just quickly go over that problem that we worked on so that I refresh your memory just really quick. Okay, so what did we do? We learned to calculate materials variances in 23.6, right? Let me get there really quick. All right, so here we are. Quickly, just to remind you, our material variance is the actual price minus standard price multiplied by actual quantity, and the direct materials efficiency variance is the actual quantity minus standard quantity multiplied by the standard price, right? And we worked over this little table and learned how we calculate total material variance as well. And then we did an exercise 23.6 where we calculated the material variances, and we said that material price variance just follows the definition, right? We just went and we calculated. We paid attention to the actual quantity because the quantity was given to us pounds per glass and number of glasses, right? We paid attention to this. And then as the next one, we calculate direct materials efficiency variance, again, just strictly by the formula. And we again paid attention to what's given to us. Pounds were not given to us. We had number of glasses and how many pounds per glass, and so forth. And therefore, we calculated all of the variances we were interested in. And we also identified with either as favorable or unfavorable, right? So now that you remember all of that, let's do 23.7. And that's calculating labor variances. The idea is the same, right? Materials, labor, the idea is very similar. What you need to do here is calculate the variances. So we'll have what? Direct labor price variance and direct labor quantity variance. Efficiency variance, right? All right, so what's given to us? We have standard direct labor time as 0.3 hour per glass, and we have a price of 13 per hour, and then the actual results for the production of 6,900 glasses were 0.2 hour per glass, total 11,380 hours, at the price of $10 per hour. So what we want to do is calculate the labor price variance and the labor efficiency variance, and the formulas, I hope we remember, right? Okay, so really quick, 2 lines calculation. Give me the numbers. First, let's make sure we know the formulas. What is our direct labor price variance? Anyone? What is the formula for direct labor price variance?
Actual price minus standard price times actual quantity.
All right. Hours, right? Quantity in hours. And the labor efficiency variance? Anyone? From your notes? It's... Huh?
Budgeted hours minus actual hours times actual rate.
Budgeted hours minus actual minus standard or budgeted, multiplied
by actual price.
Okay, so let's calculate the direct labor price variance. Whoever is late, no talking, right? Anyone got the number? 40 what? Nope. So Yeah, don't forget that it's 6,900 multiplied by what? By 0.2 or 0.3? Are we calculating the actual or are we calculating the standard? Okay, so let's look. This component, right, is what we're talking about. We have 6,900 glasses, and we need to see, is it 0.2 or 0.3? How do we know if it's 0.2 or 0.3? We're looking for actual hours, right? So you need to read very carefully. The standard direct labor time is 0.3 hour per glass, but your actual is 0.2 hour per glass. So what are we going to multiply it by? 0.2, right? Okay. So make sure you read it correctly. Okay, because there's going to be an answer with the 0.3 in the multiple choice. And you'll think you got it right. So make sure this A stands for actual. Okay, so here's what we did. We took our actual price and standard price, we subtracted one from another, and then we multiplied by actual hours. Okay, so and then the calculations, all of you know how to calculate. Oops. Is it favorable or not, the number that you get? Favorable. Why is it favorable? Your actual is less than standard, right? And we're looking for a labor price variance. Okay? So if that does make sense, go back and read. Okay, so standard was 13 per hour, and and the actual price for me was $10 per hour. That's a good thing, right? So that's why you put it as favorable. If you do not remember which one is the subtraction, go back and read the text itself. Okay? So how do we find this SP, standard price? What do we multiply by what? What is SP? So what is it? What number is that? 13, right? We're looking at the standard direct labor time at 13. And then what is AHSH? Actual
price and standard price.
Actual hours and standard hours, right? How do we, so what number did you get? All right, is it favorable or not? My standard is greater than my actual, right? Okay. Good job. All right. So obviously we spent some time on this. We might need it. Okay, so number 5. Fifth objective is where we're going to try to analyze our manufacturing overhead in standard cost system. And here we'll learn what is manufacturing overhead variances are. Okay, so what we know already is that the total overhead variance is the difference, right? You can deduce that meaning, the difference between the actual overhead cost and the standard overhead cost allocated to production, okay? So how do we calculate our overhead allocated to production? The formula is quite simple. It's your multiplication of the standard or predetermined, right, or budgeted overhead rate by standard quantity of the allocation base that's allowed for actual output. Okay. Another thing let's go over is the standard overhead rate, right? This first, to understand fully what is our overhead allocated to production, let's look at the also standard overhead rate in just a little bit of detail. What is this standard overhead rate? What does it have? Both numbers that we're going to be using in calculating standard overhead rate are the budgeted standard numbers, right? Hence the standard overhead rate. Pay attention to that. So it's the budgeted manufacturing overhead cost divided by budgeted direct labor cost. Now we also know that our manufacturing overhead cost is variable overhead and fixed overhead. So it's a variable overhead plus fixed overhead divided by budgeted direct labor hours. Okay, so if we were talking about Smart Touch, and we'll look at the exhibit in a second, and we know that our variable overhead and fixed overhead are given to us as 6,400 and 9,600. We've had that slides before, okay, just to remind you. Now what's given to us is the budgeted direct labor hours, and it's 3,200 of direct labor hours. We can put that information together and see that our standard overhead rate is $5 per direct labor hour. So we have a component that's variable, we have a component that's fixed. Put them together, we get the overhead rate, standard overhead rate at $5 per direct labor hour. So what do we do next? We can now look and compute variances. Okay, yes? As soon as we're done with this, because you guys are not doing anything if I give all of them to you. So as soon as we're done, you'll have them. Okay? What? But you're not typing. That's the problem. No, I'm sorry, I don't mean you. I don't mean you. It's just if I give all the exercises up there, you're not doing it in class. So for the benefit of the rest of the class, it's up here, you work here, and then you have the slides later. All right? And if you need your student version, it's on my lab. I've said that many times. It's on my lab. You go to the multimedia and you download them, and that's your student version. But the full version is something that I give you after the class. Okay? All right, so let's look. Now we're computing variances for the variable overhead. Now what's given to us? We have standard price for variable overhead, which is $2 per hour and 4,000 hours that were budgeted for 10,000 DVDs. That's also, you've seen this information on the previous slides. So the actual variable overhead cost was 9,000. It took 3,800 hours to make that 10,000 DVDs. All right, so what we're trying to do here is to compute the variances, and we will use the cost computed for the flexible budget and actual results, right? We also know that the variable overhead variance is $1,000. So let's look how is it represented in our spreadsheet here. We have comparison of actual results with flexible budget. So let's look at the variable overhead right here. So just as given to you, actual variable overhead is 9,000, and it's right here. And then I'm also comparing to the flexible budget for 10,000 DVDs, right? What does it give me? A subtraction of 2 gives me 1,000 of the flexible budget variance, right? We said it's a difference between the actual result at actual prices and the flexible budget for the actual output. That gives us 1,000, and it has a letter U next to it, so it's unfavorable. What does it mean it's unfavorable? It means that our actual results are greater than the budgeted at the actual output, right? Okay, so let's look at the variable overhead variances just a little closer. There are two types of those variances. The first one is the variable overhead spending or price variance, right? And the second one, yes, it's an efficiency, okay? We'll look at it in a second. Let's just figure out how do we calculate our variable overhead spending price variance. Now, just by the logic, it's a variable overhead spending, right? So it's an actual minus standard prices multiplied by the actual hours, okay? So if I if I look at it a little further and I put age right into the brackets, what do I get? I get my actual price by actual hours. And when I subtract my standard price by actual hours, now what is it? That's your, right here, actual results at actual prices and the flexible budget at the actual quantities, right? At the actual hours. So we have this 9,000, we subtract 2 by 3,800 hours, we get 1,400, which is unfavorable. And our next variance that we will calculate is the variable overhead efficiency variance. Now it's your, the formula is actual hours minus your standard hours, you multiply by the standard price, right? So again, you have some calculations to do. You plug in the numbers that are given to you. And so you have 400 at the end. And that's a favorable because with these calculations we got the negative number. If you do not remember the number, and then just think at the meaning of the brackets, right? 3,800 at the actual and 4,000 at the standard. What happened there? Is it favorable or not? Yes, it's favorable, right? All right. So let's look at fixed overhead and how we compute the fixed overhead. Oh, let me actually tell you a little more. Thought I didn't put this here. So again, that same table. So you see throughout the whole chapter we're using the same table, right? So the calculations behind are the same. We're just labeling it differently because we're changing the context of it, okay? So not that many formulas to learn, just understand the concept. So actual price by actual hours and standard price by actual hours, as we said, it's a price variance or spending variance, right? Okay. So look at this. The actual hours is the same. It's common, right, in both columns. The actual price and the standard price is what differs. So how do I figure out if it's a U or if it's an F? My spending variance is, again, a comparison of actual price, standard price. My actual price is higher than my standard price, right? I planned at $2, but it actually turned out to be $3, right? It's not a good thing. It's unfavorable. So apply that way of thinking to all of the concepts. So my standard price and actual hours multiplied minus standard price and standard hours allowed when I calculate efficiency variance, right? And then my total variable overhead variance is the difference from between the spending or price variance and the efficiency variance. So why is my variable overhead variance is unfavorable when we're talking about when we're comparing spending and efficiency variances? How can I understand quickly if it's favorable or not?
Efficiency is higher than standard, it's favorable.
If my efficiency is higher than standard? Anyone? Yeah?
Just depends which one's higher. Like in this case, since there's 1,400 unfavorable and only 400 favorable, the balance is going to be unfavorable.
That's good. Exactly. Okay? So pay attention to what you've calculated right before. And when you're putting those U's and F's, right, going all the way down, it's going to help you to calculate the rest. If you're still not sure, maybe write it all out and think of, yes?
So let's say on a general, if actual price is less than standard price, and let's say we get a negative number, like down here, -400, the negative tells you that it's favorable. But if it's a positive number that comes out of a problem, then in general we can conclude
If it's good for you to remember, right? If you can remember that it's first actual price minus standard price. If you remember that formula and you're sure of it, yes, the sign will tell you if it's unfavorable or favorable. But if you're not and you need to check it, and more likely you might not, right? Or maybe you will confuse each other. Just make sure that you can verify it with understanding what's behind that formula, right? But if you can remember the formula, it's right there. If it's positive, then it's unfavorable. If it's negative in the second case, then it's favorable. It's very easy then, right? All right, so let's move on. We have fixed overhead to look at. Okay, so this exhibit, what does it show us? It shows us, again, the Smart Touch Learning comparison of actual results with flexible budget. Same table, we're just moving just a little below. We're looking at the fixed overhead. And why did they spend more on fixed overhead than they budgeted? We want to try to understand this. Okay, so we said that the fixed overhead was 9,600. I think we just calculated this per month. Oh, it was, yeah, okay. So it was budgeted at 96. It's fixed overhead. It's budgeted 9,600, but the actual results were 12,300 as your multiplication of the actual price, actual hours, right? That formula. So we got it for 10,000 DVDs. We're making, our fixed overhead is at 9,600. So the flexible budget variance is calculated at 2,700, and it's unfavorable, right? It's my fixed overhead where my actual results are greater than my flexible budget results. Okay. So another thing that I want to quickly note here, when we're comparing our actual results with flexible budget, look at what we're looking at. So if it's variable cost, we have our direct materials, direct labor, variable overhead, and some other administrative and marketing costs, right? And then we also have another section which is fixed costs, yeah? And fixed costs are composed of fixed overhead and other expenses. And so we calculate total variable and variable cost, total fixed costs, and therefore we have total cost. Make sure that this setting is familiar to you, okay? And so that helps us to calculate all the flexible budget variances, right? We'll make a column to the right from actual results and flexible budget results, and calculate the difference of two columns, okay? All right, so let's look fixed overhead variances. What do we do here? Okay, so again, we have two types. Oh yeah, it's missing. Looks like missing. Two types of variable overhead variances. So the first one is fixed overhead spending variance, and then again the volume variance. Okay, quantity, similar to quantity, right? Volume variance. So how do we calculate, what do we calculate here? Our fixed overhead spending variance is the actual fixed overhead less budgeted fixed overhead, okay? So actual minus budgeted fixed overhead. Very simple, one column minus the other. So we just looked how we calculate 2,300 minus 9,600. We got 27, which was unfavorable, because our actual fixed overhead was higher than the budgeted, right? And then we also calculate the fixed overhead volume variance. And what is the volume variance? It's the budgeted fixed overhead minus the applied fixed overhead. What is applied fixed overhead? We're going to take into consideration this number of hours that we used up, right? That's 44,000 hours, and the same rate at $3 per hour that we had before. Okay, so it's 9,600 minus 12,000, and we calculated it as 2,400 as favorable. All right, so we are going to be applying this rate of $3 per hour to apply to the fixed overhead two jobs, right? Okay, so let's look at this little table, little illustration below that I have for you. 2 points is our spending variance, and volume variance is what we're learning to calculate. So spending variance is your difference between the actual overhead. Do you see how it got a little simpler to the left, right? We're not multiplying two things, we're just subtracting one from another, right? So it's actual fixed overhead minus your budgeted fixed overhead when you're looking for the spending variance, right? And then the volume variance is the difference between budgeted fixed overhead and then this applied fixed overhead, which is your applied fixed overhead standard price multiplied by the standard hours allowed, right? Okay. Another thing, so 2,700, why is it unfavorable? It means that we incurred $2,700 more in our fixed overhead than what we budgeted, right? And the 2,400 to the right, that's favorable. That practically means that more overhead was applied to jobs than it was budgeted, which is a good thing, right? And that resulted in the positive volume variance. All right, manufacturing overhead variances. How do we calculate? Just a second, missing slide. Okay, so in this section, let's look at the term manufacturing overhead and what is the how do we work with this? So total overhead variance is the difference between your actual overhead cost and the standard allocated to this production, to that particular production. The allocating overhead in the standard cost is calculated as the multiplication of the standard or predetermined overhead rate and the standard quantity of the allocation base that was allowed for the actual output. Okay? So again, let's look just like we did before. How do we look at the standard overhead rate? We're looking at the budgeted manufacturing overhead cost divided by budgeted direct labor. We've seen that, right? Labor hours. And then again, two components of the fixed and the variable overhead. All right? And so how do we calculate? The variable overhead and the fixed overhead are given to us. The budgeted direct labor hours is again something that we have as a direct labor hour given to us. So we have a variable component and the fixed component at the end. And we find that what is our standard overhead rate per direct labor hour. Okay, so this is just an example for you how we compute the standard variable and fixed overhead rates for our Smart Touch. And let's look at the example. How do we apply this to a problem? So we have standard overhead rates that we want to calculate. So what are the components? We have standard overhead rate, and then we'll have standard variable and standard fixed component, right? Okay, so we have static budget variable overhead, static budget fixed overhead, budget direct labor hours, and budget number of glasses, all static, given to us. Johnson allocates manufacturing overhead to production based on standard direct labor hours. Last month, Johnson reported the following actual results where actual variable overhead was 10,200, but the actual fixed was 2,830. Actual results of the production of 69 glasses, same problem, right? We're continuing. 2.2 hour per glass, and the total was 1,380 hours. So let's see, how do we calculate? Now let's remember just from the slide, a couple slides before that, that the standard overhead rate is your budgeted overhead cost divided by the budgeted direct labor hours. Okay? So how do I further calculate my standard variable and standard fixed? Make sure you are writing some of it down because the next one doesn't have almost any of that information. We'll be just calculating it. So my standard variable is going to be my static budget variable overhead, right, divided by 18. I'm going to use my direct labor hours, right, to calculate my standard variable cost. That's right. You got it right. So it's 9,000 divided by 1,800 hours, which is $5 per direct labor hour. The next what we need to calculate is the standard fixed. So we'll be utilizing our fixed overhead, right? Static budget fixed overhead of 4,500. And what about the hours? Are we going to use number of glasses, hours? What are we going to use? Huh? 1,800, that's right. All right, so we take 4,500, we divide it by 1,800 hours, and we find that the standard fixed is 2.5 per direct labor hour. Okay, so we talked a little bit ago about all sorts of variances and that it has the spending and efficiency variance. So how do we put this together to practice? Let's look at the 2310. So the problem is going to be based on everything we've done up to now. So use this data from 23.7, 23.9, and that's the two previous problems. So what we need to do is compute the variable and fixed overhead variances. Okay, so I just said that we have two types of variances there. That's our spending variances and the efficiency variance, right? For the variable, and for the fixed we have spending and the volume. All right, so when we are calculating our spending variance, we want to remember the formula, right? The formula is actual price minus standard price multiplied by the actual hours. So we take the actual hours into the brackets. We get our actual price multiplied by actual hours minus standard price by actual price. Okay. So we find our spending variance. The next is the efficiency. Again, we follow the formula. And we see that it's actual hours minus standard hours multiplied by the standard price, right? We're looking for the efficiency variance, right? So when you see a problem like that, that's all I'm looking for, right? You want to identify it also as favorable or unfavorable. And we are in our efficiency variance, we're saying it's favorable because the actual was lower than the standard, which means we were more efficient, right? We did better. Okay, so the next one is spending variance for the fixed overhead. It's actual fixed overhead minus budgeted fixed, right? So how did we calculate it just a little ago? We calculate budgeted fixed as the multiplication. That's our hours and the rate, right? Standard fixed rate of 2.5, so 1,800 by 2.5. Subtracted from 2,830. All right, so what do we see? We see that the fixed overhead, actual fixed overhead was greater than the budgeted fixed overhead, which is good, right? And now let's look at the volume variance. Budgeted fixed overhead minus your applied fixed. And again, we follow just the calculations of it. So my budgeted number was greater than the applied. In applied, I used the actual, the rate that we just calculated, right, 2.5. All right, so make sure that you can freely follow the tables, right, the little tables that I had on the bottom. They will greatly help you to understand the formulas when you're going over at home. Don't try just to memorize, because it's all H's and S's and P's, and it all looks pretty much the same, right? Try to understand behind what it means. Yes?
The
Uh-huh. Okay, so what was 1800? The 1800 was, yes. Let me just read it out to you. If I have the problem itself. It's your actual hours, right, that were, I don't have it written, but it is. And then what is another number that you're looking for? So it's your direct labor hour that was like budgeted, right? Allowed, so to say. You're going to see it as allowed in problems. 2070. Okay, so the portion is applied fixed overhead. Let me see, I have it written out. That's your, so that's what you incurred that was higher than anticipated actual fixed overhead costs. That's from your table, right, where you're finding the spending variance. Okay, so, oh, no, wait. It's given to you. I don't have the problem with me, but it's actually given to you. So it's your hours multiplied by the rate per hour, right? The way we calculate the budgeted fixed overhead is going to be given to you commonly, and the applied fixed overhead is where you're going to take your hours, which were hours that we used up, right? In this case, I think it was like 4,000, and then you're going to multiply it by the rate. That's the 3-hour rate that fixed costs that was assigned to the fixed cost to jobs. And we calculated it in, let me see which problem we did that. We've calculated, this $3 is what we got. Let me see which problem that was. That was when we were calculating the manufacturing overhead variances for standard overhead rate. We said one is the variable, which was $2 per labor hour, and then the other one was a 3, which is a fixed. So you're going to use your fixed rate of 2.5, right? That's calculated. Okay? So all of the numbers are calculated for you, right? So go back if you are confused, right? This fixed, how you got this fixed overhead, which is given to you, okay? 2070. It's a fixed overhead. You're going to know this. What you need to know is what is the rate, right, to calculate the rest. Okay? If you're reading it at home and you do not understand any of the formulas, send me an email, right? Because we have only 2 hours a week of the time available right now. And then also use the tutoring. But if you're reading at home and you do not understand, you know you can email me, right? Those who email, they get the response from me. Yes? Uh-huh. Okay.
The overhead standard rate is $2.50, right?
Say again. Standard overhead rate. I believe so, yes. Yes, standard fixed, yes. No, you calculated your variable at 5 and you calculated your fixed at 2.5, right? Mm-hmm. Okay. So the 6th one is record transactions as standard cost and prepare standard cost income statement. While we're on the subject, just let me back a little bit. So when you're preparing for the exam, because I know you're getting all anxious, it's the final, right? Don't forget that there's tutoring, okay? Utilize the people who are available for tutoring. All right? Because I'm not here all the time right now. I'm only like 2-3 hours a week when I can help you guys. So make sure you use the tutors. We have like 4 or 5 tutors that are available on a regular basis. Okay? All right. So number 6 is we're learning to record transactions. Good job yesterday. You had some of it yesterday, which I hoped you would understand how to put together, and many of you did. So let's learn how to record transactions at standard cost and prepare a standard cost income statement. For all of you who are interested, if we need to know how to journalize anything or how to record transactions, we will. Here's the whole learning objective on it, right? Okay, so let's look. Why do we need variances? Let's just remember for a second, because we want our managers to understand what is the difference, where it's coming from, right? What is affecting our business. So we want to record our variances from standard as soon as possible so that our managers can take actions. All right, so if we're looking at, and this is obviously a part of the Smart Touch records. So what do they do here? They record direct materials price variances when the materials are purchased. Right? This is very important to understand. So what we need to do is to record purchase of direct materials price variance right after, right, when materials are purchased. So let's look. We have materials inventory. We have direct materials price variance and accounts payable. So we let's look just in details at each and every line and try to understand why is it so. So entry 1, that's the top of the slide for you. We're going to record the debit to materials inventory, right, at 24,000. That's going to be recording of actual quantity of whatever, I think it was the vinyl that they purchased. So what did they purchase? They purchased 12,000 square feet of actual quantity, and the $2, which is SP. What is an SP? That's our standard price. What does it mean? That means that's budgeted, right? And that's given to you per square foot, so you multiply the 2 and you get the number that you're going to be debiting. So the next action what we're going to do is we'll credit the accounts payable. How we're going to credit it? Why is it 12,000 multiplied by 0.9? That's the actual price, right? So the accounts payable are going to have your actual price, 1.9 versus 2. Okay, we'll multiply the two numbers. We see it's 22,800. So we have a direct material price variance, which we'll put at 1,200 again as a credit. All right, so we also know, if you remember this, our direct material price variance was favorable, right? Because the actual price that we paid was less than what we budgeted. Okay? So that's an example of all of that calculation that we've done. Okay? Just another view on the variances. Okay, so what do we do with the work? What do we do with the work in process inventory? Work in process inventory is debited at standard input quantities and standard prices. So let's look again at the transactions right here. That's our entry 2. Our Smart Touch again debits the work in process inventory. They have 10,000 square feet of the standard quantity, right? And what are they multiplying it by? By $2 at the standard price. So it's our work in process. And as we said, it's debited at standard input quantities and the standard prices. All right, these are things that you might want to memorize. Okay, standard cost accounting system. So look where we're using the standard prices here. Okay, so we debited it at 20,000. What do we need to do next? We need to look at our materials inventory. So materials inventory are going to utilize your actual quantities. It's 12,000 multiplied by the standard price, which was $2, right? So just, yes?
I just have a question. So this is favorable, or is it for any type of, when you get price variance? Because sometimes we have favorable.
Sometimes unfavorable. So if it's unfavorable, where would it go?
So it's going to direct materials price variance is just going to be debited instead of credited?
So you're saying if this number, let's say, was 20,000, right? Sorry. Let's say this was 20,000, right? So what are we going to do with, how are we going to look at the direct materials price variance? It's still your accounting, right? What we're going to look at it here, we're going to say, okay, so if it's less than, it's like 1.8 something, right? So it's less, so my standard price is less than my actual price, right? That means it's unfavorable, right? So I'm going to go ahead and put it where? Am I going to put it here as the 2,800? No, right? You still need to remember it's the same accounting, right? You can't put it to the credit. Okay, so we'll put that right here, right? But we're right now talking just about this certain case for the for our Smart Touch. Okay, so if it's favorable, unfavorable, you will see where it goes, and that will tell you also if you don't quite remember which one is favorable, which one is not. Just by following your general principles, right, and understanding how you are recording transactions in accounting, you can understand that, okay, it should go to the left. I guess it's favorable or unfavorable, right? You make a decision. Okay, so the same is true for the second entry. All right, so what do we do with the direct materials efficiency variance? We have more. Okay, so we put 4,000 as our direct materials efficiency variance is the difference between the work in process inventory and materials inventory. Okay. All right, so let's look at the third and fourth entry. So again, our standard cost accounting system, we're trying to learn our journal entries, and let's look at the other rule. So we have our manufacturing wages that are debited at standard prices for direct labor hours that are actually used. Okay, so let's look at the entry 3. What do we have here? We have our manufacturing wages that are debited at $10.50, which is a standard price, and we multiply it by the actual quantity of hours, which is direct labor hours that were used, right? Okay, so the next is wages payable. How we calculate our wages payable, we use our actual quantity and the actual price. So we actually paid more than what we had for our standing price, right? So here you go. We paid more. That's favorable or not? It's not, and yet where am I putting it? So it depends on the context, right? But what you need to do is to follow your entry rules. Just follow the general notion of how you put the entry, right? So direct labor price variance is 1900, and it's debited. Alright, the next, for the fourth entry, the general rule is work in process inventory is debited for the cost, for the standard cost per direct labor hour that should have been used. Alright, so how do we calculate again? Remember your formulas. Your work in process inventory, that's practically, if you look at it, it's the way you are calculating your efficiency variance, right? Direct labor efficiency variance is the difference between your standard quantity and standard price and the actual quantity and the standard price, right? See, that's the same formula right here. So you're calculating your direct labor efficiency variance. So in this case, we're crediting 2100. All right. Are we done? No, we're not. There is more coming. So record actual overhead cost for June. No, we're not done. Manufacturing. So we record actual overhead cost. So what is it here? Entry 5. We know that 9,000, we've just calculated that 9,000 actual variable overhead plus 12,300 are giving us this manufacturing overhead at actual cost of 21,300. And so these are various accounts. What are those various accounts? They might include anything: accounts payable, accumulated depreciation, such and such and such. What you need to understand is that you record your actual overhead cost for the month of June, right? And to remind you, I'm going way too far. We calculated all of the manufacturing overhead components for the June, so it's the same, right? The same month. And then the sixth one, we record the overhead allocated to work in process inventory computed. So how do we calculate this? We find our work in process inventory as the multiplication of standard quantity of hours by the standard price. Okay, so, and then manufacturing overhead, again the same rule, the overhead allocated to work in process inventory, right? Okay, so, but that's not it. Just like 4 or 5 more. So 7, record the transfer. So you understand we're following the process, right? Now we're recording the transfer of standard cost of the DVDs completed from work in process. Now we're moving to the finished goods, okay? So what do we have here? Our 10,000 DVDs are completed, great. So 82,000 is debited to finished goods inventory, and it's moved from the work in process inventory. And we also record completion of 10,000 DVDs, where 20,000 of materials and 42 of labor and 20 of manufacturing overhead, all at standard cost. So the last, no, not the last, record the transfer of the cost of sales of the 10,000 DVDs sold at standard cost. Now we sold it, right? So cost of goods sold is debited, finished goods inventory credited to record the cost of sales of 10,000 DVDs at standard cost. All right, great, but not it. Now let's look at the closes. How do we close the manufacturing overhead account and record the overhead variance? All right, so this is quickly for you illustration of the both table of the both diagrams that I've given to you. So we have variable overhead spending variance and the fixed overhead spending variance. So the fixed overhead spending variance is debited, while fixed overhead volume variance, variable overhead efficiency variance, and the manufacturing overhead are credited. So we record overhead variance and close the manufacturing overhead account. All right, so if that was not crazy enough, let's look at the flow of costs in a standard costing system. This is very exciting. So first we're looking at the materials inventory. So look at what are the relevant Smart Touch accounts that we are utilizing after posting all of the entries. So not to switch back and forth, I just want you to look at it once I post this. Look at it, this is just for your interest, right? So I want you to understand what do we debit and credit, but I also want you to see the connection between the actual entrances and the rest of the accounts, right? I mean, all of the accounts. All right, so what do we have? We have materials inventory, manufacturing wages, overhead. That's all familiar to you from the financial accounting, right? All right. So we're almost done. Once we calculated all of the wonderful variances, now we need to look at the standard cost income statement for management. So all of that was not in vain. We have all of these variances that we put together under the manufacturing cost variances right here, right? All right, so the income statement right here, what is it going to show us? We have total manufacturing variance calculated, and it tells us that it's unfavorable at 3,900. How did we calculate this? We've learned, right, how we find this 3,900. This is a representation of the statement that puts together all of the variances. So therefore, what do we know here? June's operating income is $3,900 lower than it could have been if all our actual manufacturing costs were just as standard, right? Were the same as standard. All right. So we have some time here. Let's look at the exercises, just a couple. So we have question 1 through 4 that relies on the following data. Major Net Systems is a startup company that makes connectors for high-speed internet connection. The company has budgeted variable costs. So you see the language of the problem. This is something that you usually see, right, during the exam. Fixed cost, static budget, predicted production and sales of 100 connectors in August. And the company actually produced and sold only 84 connectors at a total cost of $21,000. So what is the flexible budget? How do we calculate the flexible budget? So I'm pretty sure you're, budgeted what? What is the number of sales? 84. So 84 multiplied by 145, and then what do I do with this? That's just one part of the flexible budget, right? Yes.
And then you add $7,000.
All right. So actual units budgeted variable cost and the budgeted fixed cost. Yay, so it's a C. Okay, that's not it, right? It's 1 through 4. 1 through 4 and we're done with this chapter, so wait a second. Okay, so what is the second one? It's a volume variance. Give me the answer. Volume variance is what? Flexible budget and the master budget cost, right? So is it an A? Is it a B? Is it a D? Or maybe a C? Huh? How did you calculate a C? How did you calculate that it's a C? Yes, so you see, now you need to understand if it's a U or if it's an F, right? You look at it, you see that it's unfavorable, so it's a C, right? It's unfavorable. Fixed cost is the same. So my actual units sold are less than budgeted units sold. So you see, I even wrote it out for you here. So sometimes if you don't remember the actual formula, right, and that's going to happen, I promise you 100%. Try to see what does it mean that my actual units sold are less than budgeted units sold, right? All right, so the next one, flexible budget variance. What is the flexible budget variance? Is the actual cost and the flexible budgeted cost, right? The difference between the two. So how do we calculate that? Right, my flexible budget variance is actual cost and flexible budget cost. But I also don't know my, what I need to figure out first is for 84 connectors, right? We figured that out, I believe. Yes, we did. And so the next is the difference, right, between the total cost of 21,000 and the 19,680. And again, is it the U or F? Check, always check, even if you remember the formula, check. All right. So the last one. Yeah, we'll go over it next time. Hold on a second. We don't want to do this right now. This is the one that I wanted you to do. Major net system has budgeted 3 hours of direct labor per connector at the standard cost of $17 per hour. During the August, technicians actually worked 189 hours, completing 84 connectors. 84 connectors actually produced were sold. Major net paid the technicians 17.8 per hour. Direct labor price variance. What's your? How do you calculate it? Got it? And so the other ones just follow the same logic. So make sure you work through something like this